Hey everybody, it's Friday. That means it's time for another episode of Trucker Money, so welcome. If you're new to it, it's where we talk about everything financial outside of the trucking industry. Trying to build an income and a life outside of trucking so that one day you can have that lifestyle that you work so hard for. And I do this because I know the lifestyle we live. I know the sacrifices we make and the hard work we put in to try to get a better life. We sacrifice a lot of things, time with our family, time with our kids, seeing your kids grow up, stuff like that. So I just want to see you get there. Too many people miss the opportunity, and I don't want that to happen to everybody. This is not financial advice. It's just me sharing my personal journey. It's meant to motivate and inspire you to go out and do some epic shit. Sorry for the language, but I'm passionate about it. So we'll talk about any side income we received, investments we made, but I like to start every episode with some kind of little lesson here. So today we're going to answer a subscriber question, and I really like this question. Somebody said, Adam, why pick individual stocks and things like that? It seems kind of risky. Why not just invest in mutual funds and ETFs and grow your money, and it'll get you there eventually too. Well, I really like that question. And honestly, I don't have a problem with people that take that approach. I don't have a problem with it at all. And truthfully, I don't only invest in single stocks. My single largest holding is Fidelity Contra Fund. It's a Fidelity Value Growth Mutual Fund. And second biggest holding, I guess, would be Fidelity Balanced Fund. I started investing in those back in my early 20s. It just stuck with them. They've done really well, and I don't ever intend to sell them. But I've kind of changed strategies a little bit, so I'm just going to keep that older stuff. I'm never going to get rid of it, but I'm also going to branch into other things. Now, I've mentioned before that I'm an income investor and that there is a place for growth, and you can do both. You can do either or, you can do both. And I am not good at picking growth stocks. It requires a little bit different analysis, and I don't understand all the technologies and everything behind a lot of these growth stocks. So I leave that to somebody else that's better at it, a mutual fund manager or people like that. And my growth aspect of my portfolio, I leave to mutual funds and ETFs. I also have a few ETFs, not very a lot of money in them, but I don't want to overlook them either because there's value in that. So today I just want to talk about, somebody wanted me to explain why I pick individual stocks over mutual funds and ETFs these days. So the first reason would be expenses. In today's world, most investment companies, brokerages, don't charge commissions anymore. So if I invest in your typical mutual fund or an index fund or an ETF, your commissions, your expense ratios could be anywhere from like 0.1% to 1%, that ratio. Some of them are a little over 1, some of them are a little less than that. But I don't see the need to pay that anymore when I can just look up the mutual fund and I could go inside of it and see all the individual holdings, and I could build my own mutual fund commission free with no expenses involved. And if you've been following, you may have picked up on that's kind of what I've done. So expenses is a big reason, and in addition to, it doesn't really meet my goals. The second reason is turnover, something called turnover. In a mutual fund and ETF, they're constantly selling some, buying others. There's this turnover. A typical turnover, and a lot of them is in the neighborhood of 20% per year. So every year, about 20% of the positions would be sold or reacquired. And turnover can negate some good results long term. One way is if you're not in a tax advantage retirement account. Every time there's turnover or a sale, that can cause a taxable event. Capital gains, things like that. And I'm not about that. Most of my money's in a tax sheltered retirement anyway. But that wouldn't be something that I would look upon favorably. And two, if you sit down and do a lot of math, the turnover can really squash compounding. compounding growth can be harmed by turnover inside of a mutual fund or ETF. So those are two big reasons right there. Excuse me. Another reason is, say you pick pick a mutual fund or ETF at random. A lot of them will have anywhere from 50 to 200 holdings, and a lot of them are companies I've never heard of, or don't even want to have any part of. So why would I go buy something that isn't anything I'm interested in investing in? I leave my money in the funds I'm in because they've done well through the years and they have good management. But going forward, I don't choose to take that approach. And say, for instance, you're in an S&P 500 index fund. They are required, because of what the goals of the fund is, to own all the stocks in the S&P 500. Well, let me tell you what, there's some trash in the S&P 500. It's strictly based on the size of the company, not performance. So you can be forced into buying crappy companies. And they may not look like crappy companies because their stock prices are propped up through volume. Anytime there's a volume of money going into a stock, it can support the price and drive the price higher regardless of what's happening with the company. And they're in the S&P 500 just basically because of their size. So that's another thing I don't really want to have a part in. Another reason is funds are weighted. Okay, so say you have an S&P 500 index fund. Well, it doesn't, anytime you put like $100 in, it doesn't take that money and break it down evenly 500 different ways, or however many positions in the S&P that they hold. It's weighted. And most funds are weighted towards technology companies like the FANG stocks: Facebook, Apple, Amazon, Netflix, Google. The only one out of that bunch that I would have any interest in buying is Apple. And they may have as much as 20-30% of the money in those stocks. So I'm forced into a weighting inside the fund that really doesn't suit me. There may be way better companies that are lower down in the S&P that I would rather have more weighting in, but you don't have a choice. When you send in money, it gets distributed according to what the allocation is for that fund. And to me, that's just a no-go also. Something that kind of goes along with that, when you send money, say you send $100 into your Vanguard S&P 500 index fund, that money will be invested into the fund when the money comes in, regardless of how do I want to say it? Regardless of what's happening with the underlying companies. Okay, say one of the top five, say the top 5 holdings are the FANG stocks. Okay, the ones I just mentioned, and they are severely overvalued right now. I'm not saying they are, I'm just saying, say that they were, for instance. You would be forced to buy these companies at an overvaluation, whether you liked it or not, when there may be underlying companies in some of the smaller positions, maybe I don't know, whatever company you can think of, down and farther down the list, that you would rather have most of the money to go in that might be on sale right now. So basically, by doing it the way I've chosen to, through individual stocks, I can buy what's on sale based on how I value it. Maybe it's a real value right now, and I want to load up on it, and I don't want to buy something that's overvalued right now. Maybe Clorox is really high. It's a great company. I want to hold them forever, but I don't necessarily want to put money in it right now because the valuation is so high, that's so expensive. But you may take a company like I don't know, Pepsi. It's at fair value right now, and I may want to plow money into that. Whereas if I held those, they were holdings in a mutual fund that I had, I would have no choice. I would be forced to buy Clorox because that's what happens when you send the money and they decide how it gets allocated. So those are a few key points there on why I prefer to buy individual stocks over buying mutual funds. So now that we've talked about that and explained a little bit, I really liked that question. Thank you for whoever asked that. I was hoping somebody would, and I could probably elaborate a little bit more on it, but I think that's a pretty good understanding of why, kind of why I do it that way right now. So let's get into June 29th through July 3rd of 2020. What I had for side income or raises, anything like that, purchases. Received some rent from a residential real estate, a rental property that I have there. I want to talk soon about, maybe next week I'll do it, of the different ways that you make money from real estate. It's not only just through receiving rents. So maybe you'll find that interesting. No dividend increases or cuts. That's sad. I like getting a raise for doing absolutely nothing other than being a loyal shareholder. I dropped the ball this week. I didn't realize the market was going to be closed today on Friday. Maybe I did, but I just forgot. It's been a hard week. You ever have one of those weeks where you didn't really do a lot? Maybe you only ran, 2,000 miles, but it just beat your ass and you're tired because you didn't get good sleep and just nothing went right. That's kind of the week I had. The money was good though, I will say that, so thank God for that. Seems like things have kind of picked up here, and we got some money back in the industry, but maybe it's only for the holiday, I don't know. Hopefully it holds up. Anyway, did receive some dividend payments though for the week. The first one would be Kimberly-Clark, ticker symbol KMB, 2.99% starting yield. Kimberly-Clark is one of those companies that held up very well through this pandemic, man. They didn't miss a beat. A lot of essentials. They make diapers, they make adult undergarments, feminine hygiene products, Kleenex, all the stuff that just went through the roof. So they've done really well. It's probably highly valued right now. Next one is Pepsi. We got a dividend payment from Pepsi, a current yield of 3.08%. Pepsi is just one of those companies I need to own way more of. It's fairly valued right now. I wouldn't say it's undervalued. If anything, maybe it's slightly on the expensive side, but Pepsi's kind of the case, and I did this with Clorox a while back. They might not be on sale, but I just need to have more because I need that kind of quality. I need more of this company in my portfolio. I need it to be a bigger percentage. So sometimes I'm willing to pay up for quality. I don't need to wait for it to go on sale. I just want to snatch it up, as much as I can afford to. But I keep getting caught in a trap here. I need to own more of certain companies like Pepsi. I really do. They need to be bigger. But I keep falling into a trap. We obviously all only have so much money to go around, and I keep getting caught up in these other ones that are just, they go on sale and the values, and I find myself buying them when I shouldn't be. I should be increasing my core holdings of companies like Pepsi. So I think I need to get back on track with that. The next payment would be PPL, which is a regulated utility. Current yield of 6.34%. Probably heard that name before. And then the last one would be LTC. They're a monthly payer. You've probably heard that. You'll hear that name once a month. Current yield of 6.0%. They are a business, a REIT, that kind of like Realty Income, but this place owns long-term care facilities. Smaller section of the portfolio. Not a big, world-class company, but it's kind of my little bit of a play on the future. Do I believe that in the future there's only going to be more and more of a demand for senior housing, long-term care, medical type facilities? I believe there is. So that's kind of my play on that. Not contributing any more money, just going to let that one ride. I'm going to let that one always be a smaller position. So that's all there is for the week of June 29th through the 3rd. And I really hope, I don't hear a lot of comments on these videos, which is fine. I do it more because I want to do it, and it's kind of my way of trying to make a difference. And I get some support from some like-minded people, which I really appreciate. I really like to hear from you guys. But I hope over time, if nothing else, this kind of thing just provokes you to think and really get interested in just getting out there and killing it. And I don't care how you do it. Real estate, stocks, hell, even if you want to expand your trucking. The reason I don't do videos on what I make trucking every week is other people do. I don't really need to. All trucking all the time makes Adam a sad boy. So I don't want my whole life and identity to be wrapped up in trucking. It's easy to do when you live in this truck. You work in the truck, you eat in the truck, you sleep in the truck. I got to get my mind away from the truck is what I got to do. And I do appreciate other people that do stuff like that, though. It's really neat to hear. So anyway, make sure you hit that like button, thumbs up. We'll see you next time.